Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. There's a lot happening in markets, as always, and we're going to cover it all. We're going to talk about the news of the day. Then we're going to look at what Warren Buffett is buying and selling. He may be retiring at the end of the year, but he is certainly not done.
No.
And then we're going to be joined by Sam Gordon to get the latest on the Australian property market.
Looking forward to it. Let's get stuck in.
News and markets.
All right, so some big news today. The latest Federal Reserve decision over in the US has come in. We're learning some interesting facts from Alphabet's lawsuit. In fact, Alphabet's share price fell about 10% on some of the news that we're learning. And we've got some news from the brewing trade war between the US and China. So, Bryce, let's start with what happened in the US with the Federal Reserve.
Not a lot is the result.
Yeah, not a lot.
Fed, Jerome Powell, chairman of the US Federal Reserve, has held interest rates over in the US, citing effectively uncertainty.
Yeah, he said that economic uncertainty had increased further since March. We obviously know what's happened in April, Liberation Day and everything that followed. And he said the risks of both higher inflation and higher unemployment had grown. You know, higher unemployment, you would think the Fed cuts rates to stimulate the economy. Higher inflation, you'd think the Fed raises rates to dull inflation. So he's kind of trapped between a rock and a hard place.
He is.
And sometimes the best thing is to do nothing at all and wait.
That's it. So the RBA meets here in Australia next week to determine what happens with the cash rate or interest rates here. So we'll certainly be keeping a close eye on that.
To move on from this story with a quote from Jerome Powell, if you talk to businesses or market participants or forecasters, everyone is just waiting to see how developments play out. And it feels like that's what we're all doing. But while we're waiting, there is so much happening with businesses, and there's a lot happening in the AI world. And I want to start by checking in on my old mate Bryce, because ChatGPT have released some information, and I was reading about it in Bloomberg. AI addiction is emerging.
Yeah.
And you're a big AI guy, so should we be worried about you?
I mean, is that a negative thing?
AI addiction. Yeah. I think addiction generally is a negative thing.
I mean, I don't even think I have scratched the surface on the true power and utility of AI in my life.
So, well, as long as you're just trying to scratch the surface and not scratch that itch, we're all good. Yeah. But yeah, look, there's a lot happening in the AI world, and Alphabet is currently being sued by the US Department of Justice in an antitrust case looking to break Alphabet up. And one of Apple's senior executives, Eddie Q, was called to testify by the government, and we learned some pretty interesting things.
He attributed the first ever decline in Safari searches last month to users turning to AI, me being one of them. To be fair, though, I don't use Safari.
Yeah, I was going to say,
I don't use Safari.
So Safari is Apple's web browser.
Yeah. As soon as I buy an Apple product, straight Chrome download.
The reason that Apple is involved in this is because Google have this deal with Apple where Google is the default search engine on the Safari browser, and they pay like $20 billion a year for that to happen. And you know that's part of what the government's looking at. But yeah, the first ever decline in Safari searches due to AI.
Crazy. So he said that Apple held a bake-off.
Yeah, well, they tested.
Between OpenAI and Google's Gemini, and this was to include the AI functionality in the iPhone or in the Apple
Safari,
Safari, and the result of that was they chose ChatGPT.
So if we can just summarize, there was a decline in search engine volume that Apple are attributing to AI, and then when Apple tested the leading AI chatbots, they chose the non-Google option. They chose OpenAI's option. Add those two things together, you can guess what happened.
It's not good news for Google.
Yeah, well, Alphabet's share price, Google's share price, fell 9.5%.
Yeah.
It recovered a little bit, but yeah, not great news for Google shareholders. Both of us amongst them.
Yeah, I mean, again, we've spoken about this last week. I'm seriously thinking about what to do with the Alphabet position. I reckon 18 months ago, I called this that it would have implications on Google search.
To be fair, you did.
And I didn't do anything about it.
But you still bought Apple. Still bought Apple.
Well, because I felt like there was still a lot to play out, but it's now starting to play out. I'm waiting for now, and I think it sort of scares me to think what might happen, but all we need is for the same commentary to come from Google that Apple has seen from Safari, and for them to say search function, and then we're in a world of trouble. So, do we sell? It's such a hard one.
Yeah, I'm not feeling it the same way.
My gut would be sell and wait to see what happens. I think that's kind of where I'm at.
Okay, well, you keep us posted with your journey.
That's what Equity Mates is all about.
Yeah. All right. Well, while Bryce ponders that, let's keep moving because there is more news. The trade war is obviously front of mind for everyone. Jerome Powell is saying we're taking a wait and see approach, and it feels like so is the rest of the world. We should call out that Trump's 90 days is evaporating pretty quickly.
We've still got 2 months. It's July 8.
Is it July 8?
Yeah, July 8.
Yeah, okay, so we're a month in.
A month in, yeah.
No deals made yet.
No deals.
Yeah,
no.
It is something to be
When are they going to
mindful
do a deal a day for 90 days?
Well,
that was the spin.
If they did a deal for a day for 90 days, they would get half the deals done that they needed done.
That's true.
So
that's what they were hoping for.
Yeah, well, they're very much behind the 8 ball. So, look, we are waiting and seeing. We are watching the clock, but there are some movements that are worth paying attention to. So, over the weekend, Scott Bessent met with his Chinese counterparts.
Yep.
They had preliminary talks in Switzerland to start hashing out a deal, the US and China, but the two sides are so far apart. So watch this space, I guess. But I think probably more notably for me is obviously JD Vance went to India, and there was a lot of talk about India being the first trade deal. China has already retaliated against India before a trade deal has even been signed. They imposed levies on Indian insecticide, which doesn't feel like a massive issue, but the commentary around it from China was, and I'll quote it, this is from a social media account linked to China's state broadcaster, quote, "The retaliation against India is to tell India to stop insisting on its wrongdoing."
I mean, Ren, that's pretty vague, to be honest.
Look, to be fair, yeah, on its wrongdoing, it is pretty vague, especially because China and India do have a history of border clashes and the like.
Yes.
But it is being reported as a move to send a signal to countries that are looking to make trade deals with the US.
Yes. It's all happening. It is all happening.
It is, yeah. So I think it's a watch, it's a wait. We obviously have covered some of the...
I think UK and India have also struck a deal, haven't they?
Yeah.
On whiskey and cars and all sorts of things.
There's a lot of non-US and non-China trade deals being struck here in Australia. I mean, Anthony Albanese said he might scrap the luxury car tax, which has always been a sticking point in an Australia-European Union trade
finally
deal.
Get your Lambo.
Yes. Which I think, from memory, it's like a $5.2 billion tax.
Yeah,
so it's a notable one to remove.
Yeah.
And the other one to note is that Australia and India have like the first stage of a free trade agreement. They signed in 2022, but it's not like fully fledged. And so there's been more progress there. I think Albanese said he's going to prioritise critical mineral exports to India to progress trade talks with New Delhi. So, yeah, there's there's some interesting stuff happening in the trade space, but really, I mean, the main game in town, the one that's going to affect markets, the one that we all are watching is the US and China story.
Yes, absolutely. To bring it back home here in Australia and to close it out with a story around individual stocks, the resurgence of buy now, pay later company Zip continues. I think last year it was up almost 900%. And last week, shares were up 11% after the company reported strong growth in US transactions. The story is obviously over in the US with Zip. The stock had fallen 98% from its high ran in 2021, but it is now up more than 500% since October 2023.
Yeah. Have you been following the buy now, pay later story in the US, just like how prevalent it's becoming?
No.
So there was some stat that more than half of the Coachella attendees buy now, pay later their tickets.
Really?
Yeah, tickets like $600.
The other half were influencers who got them for free.
Well, no, like the other people paid it out of their savings.
Yeah.
And then DoorDash has launched with Klarna, where you can now pay in full for your Uber Eats or your DoorDash orders. There's like groceries, buy now, pay later. So there's like, to my mind, there's like a concern about young consumers over leveraging themselves.
Yeah, I actually take it as it's a negative signal on financial stability.
Definitely.
Really.
Yeah. And Americans love debt. Like, they're stupid for debt.
Yeah.
The Ford came out recently and said the most common car loan they're now issuing is 84 months, so 7 years. Like, some of these people won't even own the car for 7 years.
Yeah.
And then they're getting a 7-year loan on a depreciating asset with like a 12 or 13% interest rate. It's just the levels of debt in America are crazy. Levels of consumer debt. But yeah, it's a watch for me around as buy now, pay later becomes more prevalent in America and more of these stories emerge. What will the reaction be?
Wonder how our dear old friends over at Afterpay are going.
Well,
because they were right in the middle of it.
Multi-billionaires, so I think they're okay. Look, put it this way:
block, I should say.
They're not after paying their Coachella tickets.
No. But yeah, I mean, you saw it here in Australia. The uptick in the consumption or the use of buy now, pay later coincided when there was like effectively an economic crunch. Yeah. So it's certainly not a positive thing that we're seeing. Anyway, if you'd like to keep up with all of the news, make sure you subscribe to our daily newsletter, where we'll send you a dot point summary of the most important headlines from around the world to your inbox 6 a.m. every day. And we also have a podcast that goes with it. It's called Headlines by Equity Mates. We turned those headlines into a podcast. It's available in your podcast app now.
A cheat sheet is a quick reference guide or concise summary of important information.
Warren Buffett might be retiring at the end of the year, but he has certainly not done yet. And in this segment, we're going to look at the top holdings for Warren Buffett. Ren, cheat sheet.
Cheat sheet, yes, we are back. This is the segment where we look under the hood at the portfolios of some of the world's best investors. Today we're looking at the portfolio of one of history's best investors.
Homage to Warren.
As we all sort of get reflective and a little bit teary, thinking about Warren Buffett, who's 94 now. He'll be 95 by the end of the year, achieving FIRE, hanging up the boots.
Do you reckon he's hit his number yet?
I hear 200 billion is his number, and he's close. Yeah, so he announced that he would be retiring at his annual general meeting a couple of weeks ago, and so we are having a look at his portfolio because there is still some movement there, and it's not always him picking the stocks now.
Yeah,
he's got Ted and Todd, his juniors, his proteges, who he's training up, but there is some interesting companies being added to the portfolio. But before we get to there, let's start with the top five. I'm going to say not a lot surprising in his top five holdings.
No, and in fact, we could probably name them with our eyes closed. Apple, American Express, Bank of America, Coca-Cola, and Chevron. 5 big hitters, companies that he's had in his portfolio for decades. Well, at least some of them for decades.
Yeah, all decades.
They are the bedrock of the Berkshire Buffett story.
Yeah. So, there's been a lot of stories about him selling half his Apple stake.
Yeah.
But, Apple is still his largest individual stock position. He still owns like 2% of the company.
Wild.
So that's the top 5. Not a lot of movement in the top 5 in terms of buying and selling. Obviously, Apple happened a little while ago. But as we had a look, there was a couple of companies that they added a lot to. They bought a lot more shares in. And then one company that they initiated a new position in. So let's deep dive onto those 3 companies. One company that they added, they almost doubled their holdings in. Domino's Pizza.
Love that. Not the Domino's here in Australia, though.
No.
The Domino's American version, ticker DPZ.
Which is the same company in some ways. Like Domino's Australia is the master franchise for a number of companies.
But not to be confused with him coming to the ASX and pouring money in.
Yeah. It's not like a Kmart where there's like a Kmart in the US and a Kmart in Australia that are unrelated.
Correct.
Yeah.
Yes. Yeah. They've added big dollars, but there's a reason why, and that is because Domino's is Mr. Consistent. This is a company that is continuously, is consistent in terms of revenue, it's consistent in terms of profit. So the last 3-year revenue growth has been 3%. Nothing wild.
Nothing wild
there.
Just like you look at its financials, just constantly just grinding upwards, selling more and more pizzas.
Well, yeah, selling more and more.
But where it is consistent is its profit margin.
Yeah.
So this is the last 10 years, and I'm going to say this is eerily consistent. As a percentage over the last 10 years, 9, 9, 10, 11, 11, 12, 12, 10, 12, 12.
I mean, it doesn't get much more consistent than that, does it?
Just incredibly consistent. So
it's probably spitting out a nice dividend as well.
Yeah, this is a company that's not going to shoot the lights out. It's not going to, put up crazy growth numbers, but it's just
It's
consistent.
the Buffett story, a story that he can close his eyes, shut the market down and know that in 10 years' time, it's probably going to do the exact same thing.
Yeah. My favorite Domino's Pizza America story is when
I thought you were going to say your favorite Domino's pizza.
What's your favorite Domino's Pizza? I haven't had Domino's in ages.
Harriet pumps it.
Oh my God. Surely there's better options.
It's because it's right around the corner from our house and it's piping hot.
Oh,
and
that's
she just
fair,
loves
that's
it. Yeah.
fair,
In fact, we came back from a Bucks on Sunday. This is revealing a bit too much. We came back from a Bucks on Sunday. I was hungover. It was like 10:30 in the morning or whatever it was. I walked down to Woolies. As she'd gone out the night before as well. I walk out of Woolies. I can see down the road to my house, and the Domino's driver pulls up and starts feeding Domino's into our house. I'm like, Harriet.
Oh, God.
Domino's for breakfast. Anyway.
My favorite Domino's story was when they tried to enter Italy. Yes. And they had grand ambitions. They were going to open, hundreds of stores. I think they got like 3 years in, they'd opened like 20-something stores. And the Italians resoundingly booted them out.
Said no. Yeah.
But, you can't fault the ambition. Taking pizza to the home of pizza.
No.
But so that's one company that Buffett and his team have almost doubled their holdings in. Another one that they added almost 50% to is Pool Corp. Ticker Pool. Bryce, any guesses on what Pool Corp does?
I guess manufactures, supplies and installs pools.
Close.
Pool-related products.
Yeah, pool equipment, supplies and related outdoor products.
World's leading distributor, yeah. So if we look at the numbers, some pretty incredible growth coming out of COVID in terms of revenue, 23%, 34.5%, 16%. I guess that's all the people that bought how people fled to rural properties during COVID?
Oh, I guess so.
Fled the big cities, bought houses,
I was just going to say
wanted space.
I was going to say like it was a bit of a wealth effect. Like everyone thought they had heaps of money.
Also true.
In like the bull market of like 21 and early
also
22.
True. Well, if that's the case, it's certainly reversing at the moment because they've gone backwards. The past 2 years, revenue's fallen 10% and most recently almost 4.5%. So revenue falling there. Profit margin has been squeezed down 12% down to 8%. So
yeah. So
interesting that he's
one.
added to it, but he obviously sees something there.
Yep. Maybe a bit of a turnaround story or maybe it's just a view that pool supplies are, one of those businesses
just the
people are
biggest one.
constantly, buying year on year and they're, probably the lowest cost operator because they're the biggest. So those are 2 companies that they've added to. And then finally, let's close on the new position. It's a company that people may not know the parent company name, but I reckon everyone knows, or most people know the products they distribute. The company is Constellation Brands, ticker is STZ. and it is the the maker and distributor of Corona.
Yes. Beers, wines, spirits, you name it. Constellation Brands has it. As you said, ran the biggest brands, Corona and Modelo, but they have over 100 alcohol brands in their portfolio. They've got Casa Noble Tequila, High West Whiskey. We actually have a bottle of that in the office. I think.
Yeah, shout out to High West.
Yes, Nelson's Green Briar Tennessee Whiskey, to name a few. If that's how you pronounce it.
Yeah. So look, their beer is their key market. They've got the third largest market share in the US beer market, Corona and Modelo, as you said, and then a portfolio of over 100 brands. They're an alcohol giant. I remember a few years ago they dipped their toes in the cannabis waters as well.
Yeah.
Not sure how that is going. But then it's like, okay, so that's the business. As an investment, they fell really sharply at the back end of 2024 from sort of their highs halfway through the year to the end of the year. They were down about 20%. And looking at their financials, so starting at their revenue, their sales, top line, remarkably consistent. So 5 years ago, 8.3 billion in revenue, and then it's grown 3%, 3%, 2.5%, 7%, 5%, 2.5% to now be 10.2 billion.
Nice.
So that's just a reminder that like small, consistent, gradual, consistent growth rates can, add
up
$2 billion to your sales over 6 years. So that's great. That looks good. That's a consistent business that Buffett seems to love. But how's these profit numbers? They've swung wildly between profit and loss. So the past 6 years, $3.5 billion in profit, losing $12 million, $2 billion in profit, losing $40 million, losing $71 million, $2 billion in profit, losing $80 million.
Acquisitions, maybe?
That wouldn't show up on the income statement though.
It seems to be on the margins though. I mean, profits from $2 billion, and then it's the losses are in the
small
millions. Maybe an accounting error.
I don't think that. But look, alcohol is an interesting one for me because like the narrative that we're hearing over and over again with alcohol is that people are drinking less generally.
Yes.
And young people in particular, there's been like a sharp decline in drinking. So I feel like that's an interesting like macro story to watch, and then how that affects the alcohol brands. Obviously, you'd assume the bigger ones will sort of be able to weather the storm more.
Yeah.
But interesting one to watch. So look, that's Buffett, Domino's Pizza.
Yeah.
Alcohol, pizza, and then having a swim in the pool.
Consumers,
the basic necessities of life.
That's it. Now, if you've just joined us for the first time, or you're in the early stages of your investing journey and you're wondering what are sort of the fundamentals that go into picking individual stocks, we've created a 4-step guide to help you analyze any stock. We'll put a link to the show notes so you can download that resource. It takes you through a very simple way to think through an investment thesis and start creating your own universe of individual stocks, if that's something that interests you, if you do want to try and become the next Warren Buffett. But we're going to take a break and we'll be right back with Sam Gordon with the latest on the Australian housing market. Welcome back to Equity Mates. We're here with Buyer's Agent of the Year for 2024 and a leading Australian property investor, founder of Australian Property Scout, Sam Gordon, our property expert. Welcome.
Boys, good to be back.
Sam, good to have you back.
Thank you,
boys. The
boys.
man we turn to when we want to hear what's going on in the Australian property market. I think I saw recently that we hit all-time highs again in the Australian property market.
Yeah.
So what's
I saw
been
the
happening?
median house price in Sydney is 1.79.
Yeah, man. Yeah, it's been going
House
crazy.
Median, yeah.
And Adelaide just clipped house price. Adelaide just clipped $1 million as well. So now we've got 5 of the markets in over $1 million markets for the housing market. So it's crazy, man. It's great. Do you remember when Sydney hit it? It would have been like 7-8 years ago. It hit the mill, and everyone was like, "Holy crap!" Like that's crazy. And now, man, there's so many of them.
So much for this. I know like rates have been cut once, and there's chat about more rate cuts, but it's like so much for rates going up so much and then that having a dampening effect on prices.
It's slowed down. I think it's slowed down the top end a bit, but the thing is like there's still so much competition around the bottom end. And so if like we saw the rental boom that happened in 23 and 24, and because rents rose so much, it became cheap because of where interest rates went as well. It just kept pushing up the bottom end. And so the bottom end, where it was bringing up the median, you know, even though the top end might have slowed a little bit, the bottom end started pushing so hard because those bottom end rents were pushing and then the bottom end values were pushing. So when there's so much, there's always competition at the bottom end, you know, even if interest rates do their thing, because people can always trade down if it's too expensive. So I think that's where we've seen like this kind of compression almost up of those overall values. It's crazy, but mate, the amount of $1 million markets, and Sydney at 1.7 is wild.
It is wild.
So give us the around the grounds.
Yes.
We've kind of jumped ahead and talked about how much everything's up, but give us the summary of where we're at.
Yeah, man. So like combined nationals over the quarter, combined capitals over the quarter was up 1% overall, and annually up 2.6%. So not a huge amount, but still ticking up. Exactly as you say there, with interest rates being as high as they now are, the fact that we're still seeing 2.5% over an annualized period, man, is pretty strong. The regions outperformed, so the combined regionals at 1.5% over the quarter and 5.3% over the annuals, which is pretty good, considering a lot of regional markets are actually sort of coming back. Your higher ticket regionals have been sort of sliding or stagnating a bit, but I think it's showing the value in a lot of those smaller markets that have started picking up and actually seeing a lot of steam on the outskirts of cities and on the city fringes, and then even your big regional hubs like Townsville, Rockhampton, things like that, going through serious growth cycles. In Perth, we've seen a lot of the fringe, or 2 to 3 hours from the city as well, seeing that flow-on effect of Perth now becoming so expensive and people moving to those next areas. So it doesn't surprise me at all that the combined regionals have more than doubled the growth rate of the combined capitals over the last 12 months. But then moving down into an actual city perspective, it's funny, it's almost exactly 1% across the board for the last quarter. So Sydney 1%, Melbourne 1%, Brisbane 1% growth, so actually up. Adelaide 0.9%, Perth 0.7%, Hobart 0.9%, Canberra 0.6% growth.
Really?
So everywhere's still sitting in growth, nowhere coming back for the quarter, which is very interesting to think when, again, you think that prolonged period of interest rates where they are, you think it would have that, kind of continued slowing period, but man, we're still seeing growth, so it's interesting.
And last time we caught up with you, the story was Melbourne was actually falling.
Yes.
So that trend is slowed or reversed?
It has. Well, it has. It's reversed, man, because the quarter's showing 1% growth, right? And if we run through the annualized figures, Sydney at 0.9% up. So the quarter is actually stronger than the annualized. Melbourne's still down 2.2%, but it's turned that corner, right? Because the quarterly is at the 1%. Brisbane, 7.8% growth. Adelaide, 9.8%. Perth, 10% growth annualized. Hobart, 0.5%. And Canberra actually down 0.6% over the annualized period as well. So it's very interesting to kind of watch Brisbane, Adelaide, Perth, such huge performers last year. Like when we did, I think we did the September update maybe in October when we had the data numbers from the September quarter. I think Brisbane and Adelaide were both circa 15, 16%.
Yeah.
Perth was at like 26%. To now be down at that figure, it's showing a rate of slowing. So those affordable markets have gone through a significant cycle. Some of those areas we're seeing 20, 30, 40% growth year on year for like a 2 to 3 year window. We've seen that slow, but I think there's a lot of like interesting factors at play in the market right now. Yeah, it's going to be very interesting to watch sort of what happens. But as an actual, breakdown of what's happening over the quarter and then annualized, and I think it's important to watch the annualized versus the quarter as well, because you can see where markets are potentially slowing, or potentially they're turning a corner as well, like you're sort of seeing here in the data with Melbourne too.
What are the types of places that are, I guess, experiencing the most growth at the moment? Is it the townhouses? Do you have much view on that? Having
a look at the unit markets have some unit markets in more affordable areas have started outperforming houses by a significant amount. And I think it's because the houses are obviously the most desirable product at the start. But then when house prices go significantly higher, you see this discrepancy in value and affordability ratio between that and a townhouse or a unit or a villa or something like that. So we've definitely seen a shift towards that. The only area that we haven't seen it is Melbourne, where it's sliding even further.
Too many of them.
Yeah, exactly. There's a massive oversupply down there, but the housing market is tightening up. So it's an interesting sort of dynamic to watch play out. And it's you have to understand each market intricately to really be able to pick where he's going next. But Adelaide, Perth, Brisbane, all over the last 12 months, really, really strong unit growth.
Which is just a byproduct of everyone really being, as Sydney hits 1.7 median, as you said at the top, just having to trade down until you can afford whatever you can afford.
100%. And it's all relative to city as well. So, again, whether that's, 1.7 million in Sydney or it's $1 million in Brisbane and Adelaide or slightly under for Perth, that discrepancy as it grows between those two asset classes, it always gets pulled up, especially when interest rates are where they are. Really interestingly, during COVID, when the housing markets went on such a crazy run, if we look at Brisbane in particular, the housing markets in like a lot of the areas where we bought did like 80 to 90% worth of growth in 2 years. Like it was wild. But the unit markets only did like 10 to 15%. So they did like nothing in comparison. But really interestingly, when the rental boom started, which was in 23, 24, and the back end of COVID was really heading into kind of 2022, the housing market still grew, but they started slowing. And as interest rates got jacked up, and as rent started going through this massive boom as well because of immigration policy so strong, what we started to see in the transitionary period was actually units go through a decent run as well. So it was really interesting to kind of see that transitionary period. And I think if interest rates had stayed where they were and rents had stayed where they were, I don't think we would have seen that transition into units. It would have been a lot slower. But I think because of the rental boom combined with the interest rate hikes as well, it just became so much more affordable product. Again, people trading down into what can I afford? Well, I can't even afford to rent that house anymore, let alone buy it. But this unit or this townhouse or villa is showing promise. It's funny because they can just stay in the doldrums for so long, right? This product, but when it turns that corner, and again that little bit of heat comes into the market, that supply gets dry, supply dries up. It's really interesting to see what can happen in a market, and this is where we've really been studying. Okay, well, what product in what market is going to be the next thing to go? And we've been putting a lot of time, energy, research into this piece because it's going to be. We're heading into different times. Like 2025 is a very different market to 21, 2, 3, 4, and 2026 and 7 will be very, very different as well. So we're doing everything we can to really get in front of it and pick where we think is going to be the strongest performing market and the strongest performing asset classes, heading into the next 12, 24, 36 months.
Nice. Well, I think that's a good place to wrap it. We will be doing a deep dive episode with you next week where we're going to look at the impact of the federal election on house prices.
Well, I mean, Sam just gave a massive tease, like everything there about what he's been thinking about and where they're forecasting. Tune in next week for our full-length episode with Sam.
A little tagline here, a little catchphrase I'll use as well is buyer fatigue. And I think we'll go into that next week in terms of where we're seeing sort of buyer fatigue and what that actually means. Like as a play out, because that's it can be something to really look for from that perspective, coming in, coming out as well. So we'll leave that for next week.
Nice.
Love it.
Well, wherever you're watching or listening, make sure you subscribe so you don't miss that episode.
Yes. Yeah. And also, if you want more of Sam, you can tune into his Scouting Australia podcast or your newest podcast, Sam, the Top 1%.
That's right, boys. Yes. That's right. Yes, come and have a listen. And I know we're going to be doing it very, very soon on Top 1% as well. So looking forward to it, boys.
Likewise.
Can't wait.
Thank you so much, Sam. Well, that brings us to the end of today's episode. If you really take a lot out of what we do, find a lot of value, we would appreciate if you could share this episode with a family member or a friend, or if you could just take 2 minutes to leave a rating and a review. We would really appreciate it. We love getting your feedback. But Ren, that does it. We'll be picking it up next episode.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.